All right, welcome back. Glad to be here on another quarter. Each time we're kind of taking a topic and expanding on it a little bit more. Recently, Steve has written an article about kind of AI, and yeah, I'm sure that if you've read some articles, or I know a lot of our conversations around the office are just the offshoots of how artificial intelligence is kind of being more integrated into our lives, our businesses, etc. So we thought it would be good to, from a investing perspective, how Steve is taking that perspective and integrating it with his decisions and his analysis. So Steve, one thing that you had kind of mentioned in your article was you're pointing out how much AI spending is tied to big tech companies, and you mentioned the Magnificent Seven companies. Could you expand on that a little bit, and maybe what worries you that if demand slows down, if it's not monetized, that type of stuff?
Yeah, anytime we see a lot of money chasing a really narrow part of the market, we have to be a little bit concerned. Do
Mm,
valuations really support that level? Because in the end, we're about whenever you purchase or invest, what you're looking to do is buy profit streams, right? And
mm,
buy them at a good price. And so if you're putting a lot of money to work that you have, rather than giving it to shareholders, so for example, just pick one of the big tech companies that you want, let's say Microsoft, they're putting a lot of money into developing and building out AI infrastructure and so forth. And so we have to ask ourselves as investors, are we going to get a good return on that money? Because they could always return it to us in the form of buybacks or in the
mm.
form of a dividend. And so if they're going to invest it, we expect, that to be a good return, commensurate with our expectations and our planning goals. Because if it's not, then it can be lead to subpar or suboptimal returns over a long period of time. And so that's where the thought is, Dave, of our concern at the moment is we see a lot of money, both money inside big tech, with them spending a lot of their cash flows building out AI. And the problem is if they're all competing for a space, well, then their profits are going to be less naturally. And so that's a little different than the first time they went and built out a lot of these models, if you will. And so that's one of the things we're watching. It's a lot of money. It's a lot of private equity. There's even government money now chasing AI. And usually when we see that happen, it becomes an environment ripe for overvaluation or maybe even a bubble in certain
Mm.
areas of the market. And so we are seeing where a lot of the market is being controlled by that narrative. And we wonder, with most of AI at this point, not profitable at all, not even close to profitable. In fact, we're seeing the reverse in many cases where it might be a wonderful tool, but the cost to get you that tool is growing. And so because of that, we're watching very carefully how in the world are they going to make money on this stuff.
Mm.
And it's the math is a little rough at the moment. Now it could change. Technology can change, cost of technologies can change. So we want to leave space for that. But as we're tracking the data, we do think that it's worth watching and being cautious about that at the moment. So.
Okay. And so, yeah, and what are you seeing in the like non-AI companies, other sectors?
Yeah.
How are they, how have they been impacted or not impacted over, the last 6, 12, 18 months?
Yeah, our last couple of years really it's just been choppy.
Hmm.
There's some companies done very well and some not so well. I think in aggregate they've been fairly flat, certainly compared to the general markets or like the S&P 500. So you kind of have two stories going on. You have the AI story and everything connected to those supply chains, or even just the narrative AI companies that don't have any great profit at all. Not most of them don't have profit within AI specifically, but a lot of them that don't have earnings. And then on the other side, you have the non-AI based companies that some have been going through recession-like conditions for a little while now. And so we're looking in that area because you have some beat up opportunities, if you will,
Hmm.
that we think they can leverage if AI becomes a thing, if the technology becomes a thing, they're going to be able to leverage it in their businesses in a profitable way and increase efficiencies, increase productivity if it's that good of of a thing for them. And we can then buy those companies at a much better price to profit, so to speak, get better cash flows at a better price with a little more certainty. And so we're seeing different areas, and we won't go into super details, but there's all sorts of different spaces, whether it's, companies that have been around 100 years that we're seeing revamp things, or whether it's, healthcare space just going through, and they all have their own issues, obviously, that we have to sort through. But we do see opportunity out there. But we're seeing and leaning into this idea of where certainly there was lots of opportunity in AI and the big tech companies. The values are just a little stretched now. And so it's not like we're saying sell out of those or,
Right.
completely or anything. We're not making any investment advice here. We're just saying we want to lean into balance over time. And so we're looking elsewhere and trying to lean in and balance out portfolios, as the whole world seems to be caught up in the AI narrative. We're getting a little concerned about what would happen if some of these things don't pan out quite as well as some people think they will. So
Yeah. And when you're talking, it's this kind of make me think back to kind of the dot-com era. And the answer may be no here, but do you see what similarities, if any, would you identify in the
yeah.
late 90s, early aughts?
Yeah, no, that's a great question. We look a lot at that. And I think that the answer is there are similarities. Anytime you go through a tech boom, in any industry, there's a lot of similarities. Even electric vehicles, most recently,
Mm,
there's a lot of similarities. You had a lot of money chasing, a very niche market at the time. And of course, that market's expanding. But we've seen, that hasn't really panned out. I mean, anywhere close to what people thought we were going to be at this moment. It's going to take a lot longer. And so we're similarly, back in the dot-com era, you had a lot of companies funded. Surprisingly, I mean, this surprises people. People get this wrong. It wasn't like there was a lot of debt funding those companies. These were pretty somewhat, at the time, debt-free companies that were coming onto the market, back in 97, 98, 99. But they were fueled by a lot of private equity
hmm
and IPOs, really hot IPOs, and just a lot of stock dilutions and stock-based compensation. And so we're seeing similar things to that today. A lot of companies are fueled by stock-based comp to attract top level talent. They're fueled by private equity. They're fueled by a lot of these issuing or IPOs and so forth. So we are seeing similarities there. In some companies, we are seeing similarities, like they don't have any profit, they have no reason to sell the valuations they sell at, and it's just typical boom and bust cycle kind of behavior. But on the other side, we also what's very different, in some ways, is we do have a select group of really big tech companies that are funding things. So they
hmm
have real solid, strong organic cash flows. And so if you look at a Microsoft or a Google, certainly Amazon, Apple, I mean, these companies are wonderful businesses with wonderful cash flow. So if they decide that it's not working out and they want to stop spending on AI, if they can do that, that's a different question for a different day. But they do have wonderful big cash flows that could flow back into shareholders' pockets to some degree. So it is different. We do
Yeah.
have, there are some companies, that we think are fair value that are in this space that we still are very attracted to longer term. But we are concerned there is definitely enough things that do remind us a little bit of 99. Maybe not quite to that level yet, but enough to make us pause and say, are we going there? Is that where we're headed with all of this? And then the other thing to be aware of, 99, people think of the bubble and they think of the bubble bursting. Well, the bubble didn't exactly burst in 99, 2000, 2001. It was a very slow drain. It wasn't like you think
hmm
of a bubble, it pops and boom, it popped. Like people forget real quickly, like it was, oh, down 10%, oh, up 5. Oh, okay, we're getting back to normal. Oh, down 10, oh, up 15. And it was a very slow down and back over a multi-year period. It wasn't like just one thing, like COVID was like pop and like the
Right.
market just melted down, right? Or even '08, the great financial crisis was very much a very fast and deep correction. Whereas 99 to 2002 was a 3 year long drawn out process. And
Hmm.
so usually that's what happens in these situations when you have a lot of money chasing a narrative like this, is it probably won't just die. It's going to be a slow drain over a multi-year period where eventually you look back and just say, wow, we would have been better off having more diversification or being in some other things because the narrative is true, right, Dave? Like, no one's arguing AI isn't going to change the world. No one's arguing the internet wasn't going to change the world. No one's
Yeah.
arguing AI isn't going to be amazing 5 years from now and create productivity, and there won't be a point where it doesn't work. Like, we're not arguing that. We're just saying there's a limit on the valuations, there are money limits, there's math here. And similar to the .com, that does parallel a lot of those thoughts. And the internet obviously changed the whole world, and we
Hmm.
expect AI will, but we just expect that valuations get ahead of themselves in areas. So yeah, so similar but different, but we
Yeah.
are treating it as like we do all things, remain balanced and then slowly rotate. We don't think it's going to be an overnight kind of thing. If it is, then we'll go in and try to scoop up opportunities if that's the case. But otherwise, I think balance will be the key over the next few years. So.
Well, it's great. We appreciate you taking us on a quick tour under the hood here. And I guess any final thoughts before we conclude?
No, I mean, it's been a good quarter. I think,
Yeah.
we're back to normal levels. Some of this is, the government's going to do everything they can to help fuel some of the economy, which some of it's good, some of it's not. And, we'll just take it as it comes. And if we think things are stretched, so we think there might be a little bit of a pause here, a step back. We'll see how that unfolds. But if not, we're ready to go. And so we're happy to see all the accounts are in line more or less. Obviously with markets being back near high water marks, we're happy to see clients, back to those levels. So we'll take it for now and plug away, right?
Yeah,
So
that's right. Well, we appreciate your research, your steady hand, and certainly your time today. So until next time, I guess we'll sign off and have a great day.
yeah, thanks, Dave. Take care.
Thank you. Yep. Cheers.